Good afternoon, ladies and gentlemen. Welcome to our special series of Market Gurus, where you get to meet the finest brains on Dalal Street. Our guest today is Mr. Vikas Khemani. He's the founder at Carnelian Asset Management and Advisors Private Limited. Vikas ji is a very well-known face on Dalal Street over the last 2.5 decades. He started Carnelian, which now manages 10,000 crore rupees in 2019, right around the pandemic. And before that, at 16 years at the helm of Edelweiss Securities and a short stint at ICICI Securities. Namaste Vikas ji, a very warm welcome from my side and Sakshi's side. It's such a pleasure to host you. How do you think is the sentiment on Dalal Street at these days when you have a record high on almost every other index apart from the Bank Nifty, and it's becoming increasingly difficult to find quality stocks at good prices?
Chelsea and Sakshi, thank you very much for hosting me. I think, of course, mood in the Dalal Street is very, very, buoyant, and fact that, markets are doing well, fund flows is very strong. I think things that speaks for itself. And, I probably, would say that it's not difficult to find good quality stocks at reasonable price. I think that is what we do, at Carnelian. And while, of course, things are not as cheap as they were 2 years ago, but I think there are plenty of stocks which are available from an investing perspective, where still long-term prospects are very good and the risk reward of investing is very good. So I think, and maybe we'll chat more about that.
Very good afternoon to you, Vikasji, and thank you so much for taking the time out for this wonderful chat. I want to first begin by understanding from you, how are you looking at those underlying fears that have been emerging? एक तो बड़ा correction आएगा, अब तो आना चाहिए, एक तरफा चाल हमने देखी है at 16.7% returns for the Nifty. We are also among, I think, the top performers in the APAC region now. Looking at all of these scenarios, do you really see that there could be a deeper correction, or you're saying that now markets are used to of just 1 or 2% correction and then we go on? That's all that we see in the name of correction now.
This kind of narrative has been played for since markets on Nifty was 18,000, 19,000. I think people have been waiting for correction, and I always have been saying that people who are having this view are approaching this reversion to mean perspective, that markets will revert to mean. Earlier, 16, 17 times was price to earning, and same was right. And today, if it is 22 times price to earning, it is expensive and it will revert back to mean. Those people will keep missing the opportunity, because in a transformative economy, reversion to mean doesn't work. It might work in a steady state economy, but not in a transformative economy. And India is in a transformative phase. And that's the reason we continue to remain very bullish. And maybe I can tell you that, if you look at 10, 15 years view from now, India has delivered very well, and India will deliver very well over the next 10, 15 years. Total corporate profits of India today is $150 billion. In 2001, it was $8 billion. Now, in this 22 years period, all kinds of risks have come and gone. And despite India's corporate profits have gone up significantly. And this $150 billion by 2035 will become $1 trillion. It means our market cap of India will become 20 to 25 trillion dollar, which is today around $5.5 trillion. So if you understand this perspective right in the mind, you will invest with that kind of transformation happening in the economy and invest into that. But if you believe that, and lots of people who believe that, market will revert to mean and hence, it will go back to the same levels, in my opinion, will keep missing the markets. And when I'm making this point, I'm not saying that markets will not correct. There won't be any, intermittent corrections. But I believe that if you have this perspective of very long-term India, then you will keep remaining invested and you will not keep buying this, reversion to mean narrative.
That's a very interesting thought to look at the multiple based on the overall profit on Dalal Street. And remember, this is about listed companies. There is an equally broader unlisted market in India, where we see this mad rush to now come on Dalal Street. Now, let's get into the nitty-gritty of stock picking, Vikasji. At the moment, Carnelian has launched a fund called Bharat Amrit Kal Fund. First, what is the logic behind launching this scheme? What are the sectors that you are looking for? And coming to the nitty gritty of stock picking, what is the underlying theme in this particular fund?
We've been believing that for right reason. I just said that, we believe that India is in a transformative phase, and most of the time, people look at here and now and lose the focus in the long term. So we said through this fund, we'll try to create a perspective that as India, over the next 25 years, by the time India turns 100, becomes a developed nation, what does it mean? Why it can happen? And what are the opportunities? And so we said zoom out and look at the very large picture, right? So today our GDP, which is about 3.7, $3.8 trillion, by 2047 it will become 29 $30 trillion. It means 80-90% of India's wealth is yet to be made. And if you have that perspective in mind, then we say let's look at what are the opportunities. So first build that perspective and see what will change as India transforms, what will happen, what kind of sectors will come, what kind of companies will emerge. And that is what we are trying to do in this fund. So we'll broadly invest into five broad opportunities. Financials, which is a very, very large opportunity. No economy can grow without the support of financials. And so financial BFSI is a very large opportunity. Manufacturing, which again is going through a very transformative phase in India. We think, we'll have 16 to 20x growth at a manufacturing GDP level over the next 20-25 years. And whenever this kind of opportunity comes, is a very, very big bucket of opportunity. And we've been very bullish on this segment for the last 4 years. We launched our first manufacturing fund in October 2020. Most people are launching it now. So, we think manufacturing is in a very, very different phase, and hence we would take as a second bucket. Third would be, largely the consumption basket, because as the per capita income goes from, 25 to $2,600 to $18,000, massive amount of transformation, upgrade will happen in the consumption profile of the country, and you will see again huge opportunities coming about in that. Fourth, in the services space, both IT and non-IT, India continues to remain dominant player in IT, and non-IT players such as tourism, space, education, many more segments will come about again as India economy transforms. And last but not the least, infrastructure. As we know that India is building infrastructure across roads, railways, ports, airports, everything at a very unprecedented pace. And whenever such things happen, you will find huge opportunities across various segments and sub-segments. So across these five buckets, we will look for high growth, high quality companies run by good management at a reasonable price. Our Carnelian investing philosophy is investing into high growth companies run by great management at a reasonable price, and that is what we will identify and invest into it. Just to give you a little bit finally the color on the portfolio today, our combined total portfolio characteristics is that earning growth is expected to be about 24-25%. ROE of the portfolio is 19%. Debt to equity of the portfolio is 0.1%. The PEG ratio is about 1, and beta is 0.6. So this tells you the quality of the kind of portfolio we've been able to build in this market where the narrative is stocks are very expensive, and it's very hard to find good quality companies.
That's a brilliant way to put it, and a very comprehensive list of factors that one can actually track in deciding where exactly one must be placing their bets right there in the markets. There is this other space within the markets that's also garnering all the attention, and that's the IPO space as well. I wanted to take your view, Vikasji, on how are you looking at the IPO space, and do you really think this has enough to offer to the retail investors with huge demand that is coming in, historic demands being created for some of them as well, over 100% listing on the first day itself. How should an average retail investor really look at this kind of space? There is a lot of FOMO also here because allotments are very difficult to get, and at the same time when people enter into it on the first day, the stock has already run up over 100%. How would you look at this space?
There's no one space called IPO. Of course, new companies come and you have to individually evaluate every company in that sense. So for us, it's no different whether it is IPO or listed company. The only difference is probably whenever something is very hyped, either you, like you rightly said, you don't get allocation or you don't get to buy, and on listing the juice is over. So you wait for it. Like one of the favorite theme is that look at the companies which went public in last 3-4 years and which are trading at 50 to 60% of the IPO price. Those were the good companies, but available now, because that once the euphoria is over, the companies tend to get ignored. Companies tend to get overlooked, and people move on to deal to the next IPO. So I think, if the risk reward of listed IPO or listing is not there, avoid it. You don't have to chase everything. And at least that's what we do, And in a bull market, one of the point of sign of worry at this point in time is that even average quality companies are able to IPO, and that is where I think one has to be super careful and cautious in terms of which are the companies one has to bet. In SME and MSME segment, I think huge amount of this kind of excesses are there. So I would say retail investors should be super careful, super cautious for betting their money, because when the tide turns, you will not get in those companies any exit opportunities.
Absolutely. And Vikasji, as I'm sure you are aware, there is this saying on Dalal Street these days, which you've just paraphrased very well. When you want to, the best time to buy the IPO on Dalal Street is 2 years later, when the stock has corrected substantially and all anchor investors are out, all ultra HNI financiers are out, and the initial pre-offer investors who got in with a 1 year lock-in have also exited. That's the time for sensible investors such as Vikas who hunt there. The other thing I wanted to understand in Carnelian's portfolio, Vikasji, is this 10,000 crore rupees is deployed over how many stocks? And there is this SEBI classification of large caps, mid caps and small caps. If you could just break that number into these three, so we'll get an idea what you are thinking.
So, it depends on the scheme to scheme. Each scheme has their own mandate, and so a compounder has 50 to 60% large cap, balance mid and small cap. Shift strategy has most of it, 80% is mid and small cap. Bespoke has actually again a mix of large and mid caps. Bharat Amritkal fund is about 40-45% large cap, balance mid and small cap. So for us, to be honest, market cap is not a very big deal. But what we say is that for us, what good quality management and good quality business at a reasonable price is most important. In fact, if I like a company and a business, I would rather buy it small than wait for the big. For us, the risk is not in the market cap. The risk is in the management and the business. And that is where we kind of focus more on in terms of identifying. So at each scheme would have anywhere between 25 to 30 stocks, and there will be a bit of overlap. But overall, as a firm, we could be invested into across about 50 names.
So, since there are 4 schemes, about 20 to 13 each, and some commonality, one would imagine 50 to 60 individual stocks over 10,000 crores. That's fair enough. Now, when every morning you sit with a cup of tea with your fund managers and equity strategists and analysts, what is the radar that you are looking at in terms of buying new shares or adding to these 3 or 4 existing portfolios? Is there a list of maybe 100, 120 potential investing stocks that you've identified and you are waiting for better prices to emerge? Or are you looking at their earnings and saying कि भाई ये सस्ता तो होने से रहा तो अभी से ले लो?
I think so. We have our own investment philosophy, and we track almost at any point in time 100 to 150 stocks. And whatever through our investment philosophy, we just don't buy because it is cheap. We will never buy any stock because it is cheap. We'll buy at a good company at a reasonable price, but precondition is that it should grow, because big money is made only in the growth, and risk-adjusted growth is what we are looking for. And like I was giving the characteristics of the portfolio, we have 19% ROE, 25% growth, PEG ratio of 1, debt to equity of 0.1. That tells you what kind of a portfolio we are able to construct. So, and like one of the focus for us is what we call magic basket stocks, where we keep looking for companies with a view to capture earnings growth and valuation re-rating. एंड कि जब दोनों बनता है तो ऐसे मार्केट में भी हमें ऐसे स्टॉक्स मिल जाते हैं जहां पे री-रेटिंग इज फर्दर पॉसिबल. सो एंड बट यू हैव टू हैव द पर्सपेक्टिव. आपके पास वो नजरिया होना चाहिए कि हाउ डू आइडेंटिफाई दैट कंपनी. सो वी हैव क्रिएटेड आवर ओन प्रोप्राइटरी फ्रेमवर्क. अंडर दैट वी मॉनिटर ऑलमोस्ट 100 आइडियाज every on regular basis, where you could see both earnings growth and valuation re-rating further possible. And whenever we are convinced about that, that this company's risk reward is remaining in, of buying or remaining invested or further buying is there, we act on it. So, we are, despite everybody making the case for big market correction, we are sitting almost on negligible cash. We are fully invested because we continue to remain very, very bullish on India market. And we don't care tomorrow if markets fall 5% in short term, we don't care.
Vikas ji, is there any pocket where you will say one should absolutely avoid looking in that space right now? How are you assessing some of the erstwhile outperformers, say railways, defense? Is that in the avoid list?
Basically, I think two things we avoid wherever there is a huge amount of fad or crowding out has happened. Where everybody is right now given away the common sense and started looking at things beyond what is possible. So let's say to some extent, I would say defense names, railway names, some of the new tech names, where I think there is a kind of, in some sense, fad with the feeling of missing out. People are playing out, we avoid. So that's the one situation where I would say, and can time and again it can repeat in different sectors. So it's not necessarily in these. Secondly, I think we always avoid dodgy managements, dodgy promoters, because that is where the big risk lies. And so these are the two things for us, no area in any situation. Rest everything is, I think, evaluate bottoms up based on the merits of the case and merits of the opportunity.
Vikas ji, some parts of the market, especially in the FMCG space, did not correct in terms of price, but had a substantial time correction. Some stocks obviously never moved for 3-4 years, maybe much more than that if you see the compounded CAGR. Is this a space that you are looking at, considering that one of your portfolios is the compounder as also the one that is looking at aspirational India? You mentioned upgrades in terms of consumption profile. When you look at the consumption profile, what sector or what niche of the market comes to your mind?
Last 5 years, we never bought any consumer name because we were very convinced that they will get, they will not give any return. See, very often people think the risk is only fall of the stock prices, but risk is also remaining invested into stock which give no return and something else is performing. So risk of opportunity loss. If you invested into consumer names for last 5 years, surely you didn't lose money, but you lost money which you could have made. And I think so. We never invested into consumer names in last 5 years because we felt that they may not go down, but they will not go up, and hence your opportunity cost is very high. But now we are beginning to feel that consumer there are lots of interesting ideas, opportunities. We own Dabur in our fund. So in consumer discretionary space, it's very good. Automobiles look very good. We've been owning a lot of automobiles. So there are spaces which are looking very, very attractive, very, very invest. Because as per capita income of the country goes up, we are bound to see, Indian population will consume more, new and better. And as they consume more, new, better, there will be lots of opportunities in India to kind of tap, and that is what we will do in this fund.
Okay, Vikas ji, now tell us if there is any view that you would have for the markets, for the Nifty, for the year end or for the fiscal year end. What is your own sense of where exactly will we see Nifty going forward from here? What are the kind of returns from here onwards? We are already at 16.7% so far. Do you think there is more incremental gains to go for the markets overall?
Actually, it's futile to call out any short-term targets in the Nifty. We don't invest with a short-term perspective. Our idea is to generate superior risk-adjusted return over a long period of time. Like I was telling you that as India's corporate profitability goes to $1 trillion, market cap will be $25 trillion, which is today $5 trillion. It means market Nifty will go to 1 lakh by 2035. Now, it doesn't matter, when you have that kind of journey. And we don't worry about too much what can happen in between, whether 25,000 can be 24,000, 23,000, it can be, right? But yeah, of course, one has to be careful, cautious always, and some point in time correction will come. Now, whether it comes at 25, 27, 28, nobody knows. At least I don't know. And I don't want to wait for that correction because I want to just remain invested, because people who remain invested into Indian equity stories will create superior wealth, not the ones who are trying to time out for short-term moments.
What a wonderful statement to make. Remain invested and wait for time rather than trying to time the market. Vikas ji, one major theme that will kickstart on September 18th is this rate cut on Wall Street, which might also percolate to Dalal Street over the next 6 odd months or so. Within your portfolio, how are you positioned to take this or capture this mega trend?
I think, we've been saying this for last almost 1 year that, a Fed rate has peaked out and Fed rate will come down. And one of the big implication of this is whenever Fed raises interest rates, they pull out money from the equity market, right? From emerging markets. So in last 3, 4 years, when the Fed was raising rates, they pulled out money from emerging markets and including India. And every time people thought that foreigners are negative in India, hence they're pulling money out. Actually, they didn't pull money out from India, they pulled money out from emerging markets. And India being part of the emerging markets also lost some of the money, not all. Right? So as the Fed rate reversal happens, same money flow will reverse and come back to emerging markets, including India. So one of the things I feel we've been saying that the Fed rate cut will lead to a lot of flow towards Indian markets. And we will remain in a very, very buoyant situation as far as the next 6, 12, 18 months is concerned. That liquidity will be very, very robust. I don't need to tell you what happens to when foreign liquidity and domestic liquidity comes together in this kind of market. You can, and that's the reason you can, and maybe from there you can pick up your guesstimate on the short-term market movements. But that's the one thing. Second thing, we have always said and positioned that IT is the best sector or best play on Fed rate cut. And as a result of that, despite markets being very negative on IT for last a few years, we've been very positive and bullish, and that I think will benefit from this as well. So net, whatever is happening in US is only benefiting Indian story, Indian markets, both from liquidity as well as the growth perspective.
Vikas ji, there was this narrative also that, right now is the time to raise some cash levels, wait for the right time, but you've already given us the great quote on time. But are you sitting on some amount of cash or are you fully invested right now, and what would you advise to the average retail investor?
Like I said, we are fully invested. I mentioned that, despite all this narrative, we are not sitting on cash because, we believe in Indian markets. We don't care if markets correct tomorrow for 5% because each of our company portfolio, we are fully believer that they deliver 18 to 20% return in next 3 to 5 years. And hence we don't want to, be penny wise, pound foolish, where, you wait for 5% correction, keep missing the opportunities. Ask those people who are creating this narrative since 18,000 Nifty, that markets are expensive, wait for the correction.
Correct.
And have missed out the entire wealth creation in last, 1 year or so. So, the Peter Lynch saying that more money is lost on waiting for correction than correction itself. And I think so we are fully believer in that.
Perfect. What a wonderful way to put it, and put a full stop on a lot of naysayers that are there in the market these days. Vikas ji, before we let you go, we have to ask one particular question, which is the listing of Bajaj Housing today. What a spectacular way to get India's second largest housing finance company on board. Of course, it's euphoric, therefore you will not be looking at it. But within the housing finance sector, given the tailwinds that it has, the government wanting to create 3 crore houses in 5 years between 2024 and 29, is this a sector that appeals to you? If yes, how are you playing this housing theme?
No question that housing finance is a very, very structurally large opportunity. In next 20, 25 years, as young India earns, consumes, they will need houses. India will, rebuild some of the old houses. So it's a massive opportunity. And over next 20, 25 years, it will do very well. 15 to 16% kind of growth at an industry level is quite possible. And there are very few industries which has this kind of risk profile and growth profile. So we are quite positive, and we own few, housing finance stocks in our company, in our portfolio.
Okay, Vikas ji, we are told by our guest desk that you need to leave, and there is possibly a more important engagement after ours. But thank you so much, and what a wonderful session it has been. A lot of naysayers have been asked to keep quiet, and a lot of ideas have emerged, especially on how to construct a portfolio based on return on equity, earnings growth, debt equity ratio, and of course low beta. Thank you so much for your time, and I hope you raise an equal 10,000 crore rupees in Bharat Amrit Kal Fund, and that all your schemes give a run to all the indices that they are based on. Thank you so much for your time, Vikas ji.
Thank you
very
so
much.
much.
Thank you.
That, ladies and gentlemen, was Mr. Vikas Khemani. He's the founder of Carnelian Advisors and Asset Managers. He runs 10,000 crore rupees spread over 4 schemes and has one for the moment for you. That's an ultra HNI product, but nevertheless keep an eye out on how that scheme performs. That was all from our side, Sakshi and mine. Do stay tuned into Business Today Television. There's a lot happening on the other side of this break. The Nifty at a record high, 25,401.
Absolutely. We'll wrap it up at that, but do stay tuned. We'll be back at 2:30 p.m. To tell you all about the closing action on the D Street. Stay tuned.
Of course, one key question is about the relationship between